All right, folks, gather round. We're about to embark on a financial adventure. Tonight, we're diving into the thrilling world of dividends. Yes, those magical little payments that companies give to their shareholders. Don't change the channel just yet. Trust me, this is more exciting than it sounds. This isn't as boring as watching paint dry, I promise. In fact, understanding dividends can be quite rewarding. Imagine a company as a big, juicy pie. Everyone loves pie, right? The dividend payout ratio tells you what slice of that pie gets handed out to shareholders like you and me. It's a way to share the wealth. It's basically a company's way of saying, hey, thanks for sticking with us. It's a token of appreciation for your loyalty. Here's a little something for your loyalty. But hold your horses. There's more to it than just free money. Before you start dreaming of yachts and caviar, remember this. A high payout ratio isn't always a good thing. It can sometimes signal trouble. It's like finding a $20 bill on the sidewalk. Sure, it's great now, but where's the rest of the wallet? Always look at the bigger picture. Don't worry, this isn't going to be a math class. We're not solving for X here. There are a few ways to calculate the dividend payout ratio, and none of them require a PhD. The simplest way is to divide the total dividends paid out by the company's net income. Think of it like this. If a company earns $100 and pays out $50 in dividends, its payout ratio is 50%. Easy peasy. Another way to find the ratio is to subtract the retention ratio from 1. We'll talk more about the retention ratio in a bit, but just know that it's like the payout ratio's evil twin. Now, let's meet the payout ratio's partner in crime, the retention ratio. This little fella tells you how much of the company's earnings are kept for reinvestment, debt reduction, or just plain old hoarding. It's like the company's rainy day fund. The retention ratio is the opposite of the payout ratio. If the payout ratio is 50%, the retention ratio is also 50%. Together, they always add up to 100%. Because that's how math works. So, a high retention ratio means the company is plowing its earnings back into the business, like a farmer sowing seeds for the next harvest. A low retention ratio means the company is sharing more of its profits with investors. Section 4. Mature companies versus growth companies, a dividend showdown. Not all companies are created equal, especially when it comes to dividends. When you dive into the world of investing, understanding the difference between mature companies and growth companies is crucial. Each has its own unique approach to handling profits and rewarding shareholders. Mature companies, like your grandma who keeps sending you fruitcake, tend to have higher payout ratios. These companies have been around for a long time, and they have a stable and predictable cash flow. They don't need to reinvest as much into their business because they've already established their market presence. They've already been around the block a few times, so they're more likely to share their profits with shareholders. This means that if you invest in a mature company, you can expect to receive regular dividend payments, which can be a reliable source of income. Growth companies, on the other hand, are like teenagers with a new driver's license. They'd rather spend their money on growing and expanding. These companies are in the early stages of their business life cycle and are focused on capturing market share and scaling their operations. They tend to have lower payout ratios because they're reinvesting their earnings to fuel their growth. This reinvestment is aimed at developing new products, entering new markets, and improving their competitive position. Think of it this way. Would you rather get a small slice of a pie that's constantly growing, or a large slice of a pie that's staying the same size? The choice depends on your investment goals and risk tolerance. It's a tough choice, but luckily, you don't have to decide right now. Diversifying your portfolio to include both mature and growth companies can provide a balanced approach, offering both stability and potential for growth. This way, you can enjoy the best of both worlds. Section 5. Danger Zone. Can a company pay out more than it earns? Now here's where things get really interesting. Can a company have a dividend payout ratio over 100%? The answer, my friends, is yes, but it's not sustainable. Imagine trying to eat an entire cake in one sitting. Sure, it might feel good at the moment, but you're going to regret it later. It's the same with companies. Paying out more in dividends than they earn is like living on borrowed time. Companies might do this for a short period to appease investors, but it's a red flag that something's not quite right. It's like putting a band-aid on a broken leg. Section 6. Apples to oranges. Why industry matters in dividend payouts. Finally, let's talk about why comparing dividend payout ratios across different industries is like comparing apples to oranges. It's just not fair. Each industry operates under different financial dynamics and regulatory environments, which significantly impact their dividend policies. Some industries, like real estate and utilities, are known for their high payout ratios. These sectors often have stable and predictable cash flows, making it easier for them to return a significant portion of their earnings to shareholders. These companies are often required by law to distribute a certain percentage of their earnings to shareholders. For example, real estate investment trusts, REITs, must pay out at least 90% of their taxable income as dividends. Other industries, like technology and healthcare, are more focused on growth and innovation. These companies often operate in highly competitive and rapidly changing environments. They tend to have lower payout ratios because they're reinvesting their profits to stay ahead of the curve. This reinvestment is crucial for funding research and development, expanding operations, and maintaining a competitive edge. So, the next time you're comparing dividend payout ratios, remember to keep things in perspective. A high payout ratio isn't always a sign of a good investment, nor is a low payout ratio necessarily a bad one. It's not always about finding the highest number. It's about understanding the context behind those numbers and what they mean for the company's future prospects. It's about finding the right investment for your individual needs and risk tolerance. Always consider the bigger picture and how a company's dividend policy aligns with your financial goals.